Buying a home for the first time can be extremely exciting, but if you don't know what to look out for, it can be really stressful and potentially costly. So let me walk you through what you need to look out for, what requirements you need to meet, and what information you need to provide to make the process more exciting rather than stressful. So let's jump into it. Hey, what's up guys? I'm Ben Sund. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. We don't just talk about buying our first houses, we also talk about improving our overall financial health through things like personal finance, building credit, investing in real estate. And I upload once, sometimes twice every week. And so you gotta hit that big red subscribe button and jump on this train with us. So technically you can just call your realtor and say, hey, I wanna buy a house. And they'll show you some houses. But you're probably gonna need some money to do that. And unless you have cash, you're gonna have to get a mortgage. And so the first step in that process is to get pre-qualified or pre-approved. This is where you talk to your lender. If you're already working with a real estate agent, ask that they refer you a lender. But this is where the lender pulls your credit, they look at how much debt you have, and they talk to you about your income. Like, are you self-employed, or are you a regular employee, or are you a temp? We'll talk about more of the requirements that, like the credit and income requirements that are required for a mortgage in just a second. But they're gonna give you what's called a pre-qualification or a pre-approval letter. There's a little bit of a difference, so let's first cover the differences between those, because one can save you a bunch of time up front and maybe cost you time on the back end, and one can cost you time on the front end and maybe save you a little time on the back end. Either one of these is fine. You just wanna make sure that you understand the differences and be able to ask your lender what their process is so that you know going in what to expect before you start making offers or before you start looking at homes. So a pre-qualification is where the lender pulls your credit, and then they ask you how much money you make, and they look at how much debt you have, and then they issue you a letter stating how much you're pre-qualified for based on what you told them that you make. The advantage here is that they can usually have this done in about an hour. And so you could have a letter within an hour, and then you could go make offers on the home that same day. The disadvantage here is that if you're not accurate or 100% accurate on your figures, then it could be detrimental to your ability to qualify later on, especially if the lender went up to your maximum amount. And this is because the lender didn't actually review any of your income or your asset docs. It's just based on what you told them. Now, with a pre-approval, they're gonna ask you a lot of the same questions, only they're gonna make you submit your income and asset docs to them so that they can have an underwriter review. The disadvantage here is that it can take anywhere from a couple days to a couple weeks for them to review this information and give you a letter back. So if you want to make an offer on a home the next day, you're probably not going to be able to do it. One of the advantages though is that since they reviewed all the information ahead of time, it's going to prevent questions on the back end, and it's a more secure approval because they've already looked at the information and they didn't just rely on your stated income. So a good question to ask your first lender is going to be, do they do a pre-qualification or a pre-approval, and ask them to explain their process. Not all lenders handle these the same way, and so it's a good idea that you understand their process. It's also a good idea to shop 3 different lenders. Use your rule of 3. This not only is going to be able to help you understand their process, but it's also going to help you compete those lenders against each other to get the best deal, best interest rate, best closing costs, and best down payment for your particular situation. Now, whether you do a pre-qualification or a pre-approval, you're gonna have to meet some basic guidelines for the types of loans that you're gonna do. I'm gonna cover FHA and conventional. Those are the 2 most common loan types. So the first, let's start with FHA. You're gonna have to get at least a 580 credit score, but a lot of lenders are gonna require a 600 credit score. With conventional, you're gonna have to have at least a 620 credit score. I won't go into too much detail about these loan types. I've made videos on them. They're on my mortgage playlist right up there. So you can check that out after this video, of course. But with a conventional mortgage, you're gonna have to have at least a 620. And generally speaking, conventional is the route that you're gonna wanna go if you have a slightly bigger down payment, and you're gonna get the best interest rate if you have a higher credit score with conventional. So if you have like a 740 credit score, conventional is gonna be the route that you wanna look for. Now with an FHA, you're gonna have to put 3.5% down, meaning you have to have 3.5% into the transaction, regardless of the down payment assistance, regardless of whether or not the sellers are going to pay any of your costs, you have to have 3.5% into the transaction. On a conventional mortgage, you're going to have 3 to 5% down. It'll kind of depend on the type of home you're buying. Like if you're buying a manufactured home, generally you're going to have to put at least 5% down. And you may be required to put less down, like 3% down if you're a first-time home buyer or something like that. It'll kind of depend on your particular situation. But generally speaking, on a conventional mortgage, it's going to be 3 to 5% down, not the 20% down that a lot of people think that you need to put down. The 20% down is if you want to remove private mortgage insurance. And the other major requirement is that you're going to have to be able to prove your income. For mortgages, generally speaking, you're going to have at least 2 years job history. This doesn't mean 2 years on the same job or 2 years in the same field of work, unless you're self-employed or independent contractor. We'll talk about that more in just a second. But if you're just a standard W-2 employee, you're going to have at least 2 years work history. This can be supplemented a little bit with military or college, but you're still going to need at least some work history for like a conventional mortgage. And you'll have to have been on your current job for at least 30 days. And so if you're a W-2 employee, then you're going to have to be able to provide 2 years W-2s, 30 days recent pay stubs, and bank statements showing that you have the money to close the loan. If you don't actually have that money yet, you're going to want to talk to your lender about, are you planning to save it up? Are you getting a gift from a relative or something like that? Each lender is going to have a slightly different way of handling this. So you're going to want to talk to them ahead of time about your plans for how you're actually going to close the loan. And keep in mind, you might not actually need to have the money right now. You don't give the money to the lender right now. You give it to them at closing. But you're going to want to let them know ahead of time what your plans are, because you don't want to get to the closing table and not actually have the money. And then if you're self-employed or an independent contractor, you're going to have owned the business for 2 years. So you can't have owned different businesses. You have to own that business or be a contractor on the same jobs for 2 years. And you're going to have to be able to provide 2 years tax returns showing that income. So if you're a contractor or a self-employed borrower and you do a lot of tax write-offs to get your income, your taxable income down, that's going to impact your ability to qualify. Because let's say you have a company that makes $100 grand a year and you write off everything and it shows that you only bring in $10,000 a year, the mortgage lender is going to have to go off that $10,000 mark. And you need tax returns to be able to prove what your income actually is so that they can look at that. And kind of along the income verification lines, it kind of brings us to one of the major requirements of a mortgage. And that is a ratio that lenders use to determine how much you can qualify for. Don't let your eyes glaze over here. It's called the debt to income ratio. It means how much of your income is going towards debt each month. And it's pretty simple. Let's say you make $10,000 a month and you have $5,000 a month going towards debt. This is going to be dead set of reporting on your credit report. So things like credit cards, car loans, student loans, medical bills. It's not going to be things like utility bills or cell phone or something like that. It's only things reporting on your credit report. Down below in the description, there's going to be a link to a free credit report or places that you can pull a free credit report. I don't have any affiliation or anything like that. It's just where you can pull a free copy of your credit report. I recommend everyone do that ahead of time to make sure that you know that there's nothing like weird reporting on your credit report. It's also going to be able to tell you what is reporting on your credit report so that if you have small things like credit cards or collections or something like that, you could pay them off ahead of time. That's going to help strengthen your credit score, but it's also going to help strengthen the debt to income ratio. And that could help you potentially qualify for more home. And so if you make $10,000 a month and you have $5,000 a month going towards debt, you're going to have a debt to income ratio of about 50%. A lender, generally speaking, is going to be able to approve you for a mortgage of 45%. So if you make your $10,000 a month and you have $2,000 going towards debt, a lender is going to be able to approve you for a mortgage, including taxes and property taxes and insurance, for about $2,500 a month. And the nice thing about this is you can actually do this calculation yourself. You can plug in your income and look at your credit report and see what all is reporting on your credit report and do the calculation. If you make $2,000 a month and you have, $1,000 coming out, you're going to have a debt to income ratio of 50%. And while I do recommend that you still apply if you're interested in a home, that way you can get a plan together so that you can work with a lender and talk to them about like how you could potentially get your debt to income ratio in line. But it's going to give you a good idea with some simple math on what you could potentially qualify for ahead of time. And that way you could take some steps ahead of time to make sure that you get the home that you actually want. All right, so after you have your pre-qualification or your pre-approval done, you're going to get what's called a pre-qualification or pre-approval letter. This is the letter that you're going to be able to issue to your realtor or a seller and let them know that you're actually able to buy a house. It's going to tell your interest rate, your closing costs, and your down payment on it. So this is actually a great tool to be able to compete lenders against each other. That way you can kind of shop them. And a lot of lenders will actually price match. They don't tell you that, but they'll price match. And you can compete them against each other to get the lowest rate and the best closing costs. But once you have this letter, you can actually write offers on houses and get together a purchase agreement. And just in case you don't know, a purchase agreement is the agreement that you and the sellers and the realtors all sign, and it has the details of your transaction. So it's going to have how much you're buying the home for. It's going to have what type of loan you're getting, what your down payment is. It's going to be where you agree if the sellers are paying any of your costs or if they're leaving anything behind, like appliances or hot tubs or pool tables or something like that. It's basically the agreement that tells all the details of the transaction so that when you get the home later on, because you might not be going through the home regularly throughout this process, it guarantees that the home is in the condition which you've seen it in and that they don't like go and take out the refrigerator or the washer and dryer or something that you agreed upon. It puts it all in writing and it's a binding contract, so things can't change or there could be legal action involved. So once you have a purchase agreement together, this is actually where you get back with your lender and you sign an application and you start the actual mortgage process. This is where we'll pick up and I'll explain the mortgage process, some of the information that you're going to provide, and like how you progress through the mortgage process, through underwriting into the closing table. So once you have your purchase agreement, this is where you get back with your lender and you start signing an application. It's like 50 pages. It's going to tell you all the things about your mortgage, all the federal requirements that are required with the mortgage. And this is where you're actually going to have to provide like your W-2s, your pay stubs, your bank statements, your tax returns, all the information that we talked about earlier. If you've already provided those, then they shouldn't be asking you for them again. If you haven't provided those yet, now would be the time. And as a quick side note, now's not the time to make any big life moves, any big decisions. So don't go get any new credit. Now's not the time to buy a car. Don't make any big job changes. This actually does happen quite often. Don't make any big job changes, at least not without talking to your lender ahead of time, because it could, depending on the type of job that you get, it could completely cancel your ability to buy a home. And then don't go move any money around, meaning don't make any huge deposits or don't try to consolidate all your money into one account. It doesn't need to be in one account. You'll just have to provide additional bank statements. But if you move your money, that's going to create more issues or more questions that the underwriter is going to have. So just try to keep everything steady, keep everything the same. And if you want to make changes, make sure that you consult with your lender ahead of time because you don't want to create any additional problems in the underwriting stage, which is what we're going to talk about now. So once you've signed the application and turned in all the requested docs, your loan's going to get submitted to what's called underwriting. I'm sure you've heard stories of it. It can be kind of stressful and may seem a little intrusive, but what an underwriter looks for is they look at all your credit, your income, your bank statements, and they make sure that your situation meets the loan requirements that you're applying for. So if you're applying for an FHA loan, you're going to have to meet FHA requirements. Same with conventional, VA, USDA rural development. Each loan type has their own requirements and they need to fit your situation into those requirements. And this can take usually 1 to 2 weeks. It's usually why the mortgage process as a whole takes about 30 days. Now, where it gets so stressful is sometimes it can be a waiting game and you don't hear anything back. Other times they could come back with a whole list of questions that, you know, it feels like they're asking for your firstborn or your arm or your leg. And so generally what they're going to look for is they're going to look for things like large deposits in your bank statements. So if you had $2,000 of cash at home and you go deposit it, And they're going to see that because you have to submit 2 months bank statements to them. They're going to ask about that, and they're going to have you write an explanation for that. They're going to contact your employer to make sure that you're still employed and that you are making the amount that your W-2s and your pay stubs say that you're making. They're going to call your landlord if you have one, and they're going to ask about your payment history. They're going to verify that that's where you live and that's where you're making payments. They're going to ask basically every question that they have to ask in order to make sure that you meet those guideline loan requirements. And this is also where you get your appraisal back. The appraisal tells the value on the home, but it also tells like if there's big structural issues or if there's like heating and cooling issues or major things with the home, they're going to require other inspections. If there's any repairs, this is where you would find out if there's any repairs on the home. And obviously that's going to influence the situation. That can either extend the process because there might need to be repairs done. It could also kill the process because if there's too many repairs, you could decide to back out, or the sellers could say they're not paying for them. And obviously, since you don't own the home yet, you don't want to pay for repairs on a home that you don't own. And so this is another big piece of the puzzle. A kind of a side note here is that, well, it's not required. It's typically recommended that above the appraisal, because the appraiser is looking for value in big things, it's recommended that you spend the additional $400 or $500 and get your own individual home inspection. This is going to give you a more detailed look at the home. They might be able to look for mold or like smaller things that aren't necessarily seen in the appraisal or things that the appraiser's not looking for. Again, it's not required, but it is recommended because it's going to give you a better peace of mind and an in-depth look at the home that you're buying. And again, the underwriting process can seem daunting. It can take a couple weeks, which can seem like forever when you're really excited to get your home. But the quicker that you can get their questions answered or the information that they ask for, the quicker you can submit it back to underwriting for review, because they review it initially, ask the questions that they need to ask, you try to collect all the information that they request all in one go, and then they re-review it and they see if they have other questions, or they say, hey, we're fully approved and we're ready to close the loan. And so the quicker that you can get their questions asked or the documentation that they need, you can get to the closing table, which is the next step. So once you get through underwriting, you're ready to close. It's done through a title company or a law office. And again, there's not much that you have to do here. The lender and the realtor are going to help set this up. So you just have to show up, sign your name a couple hundred times, and you actually hand them the check or the money order. It can't be cash, for the down payment and any closing costs that you're responsible for, and you leave the closing with a new home. You're a homeowner. So you know what to look for and you know the basics, but maybe you want some more information. Check out this mortgage playlist where I have videos that describe the mortgage loans in greater detail, and I have some videos that give you an in-depth look on how to find down payment assistance and how to get a home for zero down and zero closing costs. So we'll see you there.